welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to have you with us.
So we're diving into something pretty exciting. How to find off-market deals in 2026.
Yeah, that's a hot topic. Off-market deals can really change the game for investors, especially if you're looking to build long-term wealth.
Exactly. You know, a lot of people think all the good deals are out there on the MLS or other listing sites, but there's so much potential when you look off-market.
Right, and it can save you money too. Plus, you're not battling as many buyers, which can make the whole process less stressful.
We'll cover some practical strategies today, like networking, leveraging technology, and digging into local markets.
And let's not forget about the importance of building relationships with real estate agents and other professionals. They can be a great source for finding those hidden gems.
Yes, I'm really looking forward to digging into those points. I think it'll be super helpful for our listeners who are just starting, or even those who've been in the game for a while.
For sure. So let's get started with our first strategy. You know, Sarah, when we talk about finding off-market deals, it's really about timing. And right now, I think it's more crucial than ever for folks over 40 to pay attention.
Absolutely, Mike. I mean, with retirement timelines looming for many of our listeners, it's like a ticking clock, right? They want to make sure their investments are solid.
Exactly. And let's face it, the traditional routes of investing, like buying homes on the open market, are becoming increasingly competitive and expensive. More and more people are jumping into real estate, which drives prices up.
Yeah, and with inflation being what it is, the cost of living is rising. So, those who are over 40 really need to think about how to protect their wealth. Off-market deals can offer that opportunity. Less competition means potentially better prices.
Right. I remember working with a client, let's call him Tom. He was in his early 50s and had saved diligently for retirement. But with the way inflation was creeping up, he was worried that his savings wouldn't stretch far enough.
That's a valid concern, especially when you consider the rising costs of healthcare and living expenses. So what did Tom do?
Well, Tom started exploring off-market deals. He found a multifamily property that wasn't listed publicly. It was a bit of a fixer-upper, but he negotiated directly with the owner and ended up buying it for significantly less than market value.
That's impressive. I mean, by doing that, he essentially insulated himself from some of the market fluctuations, right?
Exactly. And the best part? He was able to increase the property's value through renovations, which not only provided him cash flow from rental income, but also built equity for his retirement. A real win-win.
And that's something a lot of people overlook. It's not just about the immediate investment. It's about the long-term security it can provide.
Right. And with the current economic trends, we're seeing a wealth transfer happening. Many baby boomers are passing down their assets to their children.
So it's kind of like a double whammy, huh? Not only are they looking for ways to secure their own future, but they're also thinking about how to leave a legacy for their family.
Exactly. And off-market deals can play a big role in that. Imagine if you find a property that you can renovate and then pass on to your kids. It's not just about today. It's about creating generational wealth.
That's such a great point. Plus, it can give you peace of mind knowing you're setting things up for your family's future.
Right. And let's not forget the emotional side of financial security. For many, being able to retire comfortably means less stress, more time with family, and the freedom to enjoy life.
Yeah, I mean, who wouldn't want that? It's about more than just numbers on a spreadsheet. It's about the life you want to live.
Exactly. And with the market shifts we're seeing, it's important to be proactive rather than reactive. If you can tap into off-market strategies now, you can better position yourself against rising prices and competition.
And it can also help cushion against potential economic downturns, right? If you've got a diverse portfolio, especially with off-market properties that aren't as influenced by the whims of the open market.
Spot on. Like I said, it's about creating that buffer. I worked with a couple, let's call them Lisa and John, who were nearing retirement. They were initially hesitant about jumping into real estate, but once they discovered off-market opportunities, everything changed.
What happened?
They found a small apartment building that had been neglected but was in a great location. They were able to negotiate directly with the owner who was looking to sell quickly, and they got it at a fair price.
That's a fantastic example. So they not only secured a solid investment, but also improved the property, which increased its value.
Exactly. And now they have steady rental income that helps supplement their retirement. It's all about thinking outside the box.
So true. And for those listening, I think it's a reminder that there are opportunities out there. You just have to be willing to look for them.
Right. And the willingness to network, to ask questions, and to get creative can lead to some incredible finds. It's about being resourceful.
And that's why understanding the current market dynamics is so important. It's not just about finding a property. It's about finding the right property that fits your long-term goals.
Exactly. And for those over 40, it means taking control of your financial future rather than just letting the market dictate your path.
So it sounds like we're really gearing up to dive into some strategies that can help our listeners find these off-market deals, right?
Absolutely. It's time to explore how to tap into these opportunities effectively. Let's get into it. So let's dive into some of those core strategies to find off-market deals, right? A great starting point is understanding the asterisk 1% rule.
Oh yeah, the 1% rule, that's where you aim for the property to generate about 1% of its purchase price in monthly rent, correct?
Exactly. So if you're looking at a property priced at $200,000, you'd want to see it rent for around $2,000 a month. It's a quick way to gauge whether a property could be a good investment.
Got it. And that's pretty helpful for quick evaluations, but what if the property doesn't meet that rule?
Well, you have to dig deeper, right? The 1% rule is a guideline, not a hard and fast rule. You might find properties in a high demand area where rents are lower, but the appreciation potential is strong, you know?
So then you'd want to consider the asterisk 50% rule times asterisk too, right?
Yes. The 50% rule suggests that about 50% of your rental income will go towards expenses, things like property management, maintenance, insurance, and vacancies.
So let's say you get that $2,000 monthly rent. According to the 50% rule, you'd expect to spend about $1,000 on expenses?
Right. So if you're looking at cash flow, you want to make sure that after expenses, you're still in the green.
And that's where evaluating the cash-on-cash return comes into play. Huh?
Absolutely. Cash-on-cash return measures the return on your actual cash invested. So if you put down $50,000 on that $200,000 property, and after expenses, you're netting $500 a month, you'd calculate that as
$6,000 a year, right?
Exactly. Then divide that by your cash investment. So $6,000 divided by $50,000 gives you a 12% cash-on-cash return.
Wow, that's a solid return. But what about financing options?
Good question. Traditional financing through banks is common, but you might also want to consider private money lenders or hard money loans for off-market deals.
Those can be a bit more expensive, right?
Yeah, they can be, but sometimes they're the only option when you're looking at distressed properties or need quick funding. Just be sure to factor those costs into your overall calculations.
And speaking of distressed properties, how do we find these off-market deals in the first place?
One effective method is to network, both online and offline. Attend local real estate meetups, join Facebook groups focused on investing, and connect with other investors.
I've heard that word of mouth can be powerful too.
Absolutely. Sometimes you'll hear about a property before it officially hits the market, especially if you build good relationships with real estate agents or other investors.
What about direct marketing? Is that something people do?
Yes. Sending out letters or postcards to specific neighborhoods can work wonders. You can target absentee owners or properties that look neglected.
Right, so you're hitting the people who might be more motivated to sell.
Exactly. And another strategy is to look for asterisk, Cheney, chaffed pre-foreclosure properties. You can find these by checking public records for notices of default.
That's interesting. So you'd want to act quickly, huh?
Yes, timing is crucial. Many homeowners in distress are looking for quick, fair solutions, so if you can present a solid offer, you might stand out.
What about online resources? Are there platforms that can help?
For sure. Websites like Zillow, Redfin, or even auction sites can provide insights. But remember, many listings are still on market. You'll have to sift through them to find the hidden gems.
And then there are also property types to consider, right?
Right. Single-family homes are popular, but don't overlook multifamily units. They can provide multiple income streams, which can be beneficial for cash flow.
Plus, commercial properties can be an option too, if someone's ready for that level of investment.
Definitely. Just be aware that commercial financing can be a bit different and often requires a larger down payment.
So would you say it's good to have a checklist when evaluating potential deals?
Absolutely. A good checklist could include factors like location, property condition, potential rental income, and your financing options.
Ah, so keeping it organized makes it easier to compare?
Exactly. And don't forget to factor in the asterisk as well. It's the net operating income divided by the property price, helping you assess the investment's potential profitability.
So if a property has a net operating income of $20,000 and is priced at $200,000, that would be a
10% cap rate, which is quite attractive in most markets.
wow, that's a lot of numbers. But it makes sense when you break it down like that.
Yeah, and the more familiar you get with these metrics, the easier it becomes to spot good deals.
So what about the common pitfalls?
Well, that's a big topic, and it's crucial to avoid the mistakes that many new investors make.
Like what?
We can get into that next. So, one of the biggest pitfalls I see, Sarah, is investors getting caught up in the excitement and over-leveraging themselves.
Right, over-leveraging, that's when people borrow too much, isn't it?
Exactly. They see a great deal and think, I need to jump in now. But they don't account for all the costs, or their ability to manage the debt.
Yeah, that can be really dangerous. I mean, if the market shifts or if something unexpected happens.
You could find yourself in a tight spot, for sure. I had a client once who bought a property with a high loan-to-value ratio. They thought they'd flip it quickly for profit, but the market turned and they ended up stuck.
Oh no, what happened?
Well, they still had to cover the mortgage payments, property taxes. All those costs add up. They ended up selling at a loss, and it took years to recover.
That's tough. So what's the takeaway there? How can someone avoid over-leveraging?
Well, it's crucial to have a solid financial plan in place. You should always leave some room for unexpected expenses, right? Plus, keeping your debt-to-income ratio in check can help you avoid that pitfall.
Makes total sense. And what about bad tenants? That's another common issue, isn't it?
Absolutely. I've seen investors jump into renting without doing proper background checks.
Oh, that's risky. What can go wrong there?
I had a colleague who didn't vet his tenants well. He ended up with someone who didn't pay rent for months, and it took a long time to evict them.
Yikes. That sounds stressful.
It really was. They lost not only the rental income, but had to spend money on legal fees too. It's essential to check references, employment history, and even previous rental experiences.
So it's not just about finding someone to fill the spot quickly, is it?
Exactly. It's about finding the right person, someone who will respect the property and pay on time. You want a smooth relationship, not a headache.
Right, and then there's cash flow, which I know you're passionate about.
Yes. Ignoring cash flow can be a huge mistake. Some investors focus too much on appreciation, thinking, I'll just hold on to this property and it'll go up in value. But if it's not generating cash flow, they can struggle.
So what's a real-life example of that?
I had a friend who invested in a property in a trendy area. He thought it would appreciate quickly, but the rents didn't cover the mortgage. He ended up having to dip into his savings every month.
That sounds stressful.
It was. And when the market stabilized, he realized he was just burning through his savings without any return.
So what should investors focus on instead?
Always prioritize cash flow. Look for properties that not only have potential for appreciation, but also generate enough income to cover your costs.
And then there's the whole timing the market thing, right?
Absolutely. So many people think they can time their investments perfectly.
Yeah, I've heard that's a losing game.
It really is. I had a client who was waiting for the perfect moment to invest. But while he waited, property values kept rising. When he finally bought in, he paid a premium.
That's frustrating.
It is. The lesson here is that it's often better to invest consistently over time, rather than trying to guess when to jump in.
So, focus on your strategy and stick to it.
Exactly. And then there's hidden costs. Many new investors overlook those.
Like what?
Well, things like maintenance, property management fees, or even unexpected repairs can add up quickly.
I bet. Do you have an example of someone who got caught off guard by that?
Yes, I know an investor who bought a fixer-upper thinking it just needed some cosmetic work. But once they got into it, they found significant plumbing issues.
Oh no.
Yeah, it ended up costing them thousands more than they budgeted for. They hadn't accounted for those hidden costs, which really ate into their profit.
So how can investors spot these red flags early?
A thorough inspection is key. Get a professional to check everything out before you buy, and always budget for the unexpected.
That makes total sense.
And don't forget, it's important to stay informed about the market and property conditions. If something seems off, trust your instincts.
So what's the best way to recover from making these mistakes?
Well, first, don't panic. Every investor makes mistakes along the way. It's about learning and adapting. If you find yourself in a tough spot, reassess your financial situation and your goals.
And maybe seek help from a professional?
Definitely. Having a mentor or advisor can provide perspective and help you navigate tricky situations.
Right. And also staying involved in your local real estate community can be beneficial.
Yes. Networking with other investors can help you learn from their experiences and avoid those common pitfalls.
Great advice, Mike. So, it sounds like the key is to stay informed, be strategic, and don't rush into things.
Exactly. Real estate investing is a marathon, not a sprint.
I love that analogy. It's all about pacing yourself and making informed decisions along the way.
Yes, and remember, it's okay to make mistakes as long as you learn from them and keep moving forward.
Wonderful insights, Mike. That's a lot to think about for our listeners as they explore off-market deals.
Absolutely. And I'm excited to discuss the next steps with them. All right, so let's dive into some immediate steps you can take to find those off-market deals, right?
Yeah, where do you even start?
Well, first off, I'd recommend setting aside a bit of time each week to analyze at least one potential deal. Just one, It can really help you get into the habit of looking at properties critically.
That sounds manageable. Just one a week, right?
Exactly. And don't worry if you don't feel like an expert at first. Just start where you are and build from there.
Got it. And what about tools? There's got to be some good apps or websites to help with this.
For sure. A great starting point is Zillow. You can find not just listed properties, but also get a sense of market trends.
Yeah, I've used Zillow before. It's pretty user-friendly.
Right? Another tool I really like is the BiggerPockets calculator. It's fantastic for running the numbers on investment properties, especially if you're trying to figure out cash flow or ROI.
I've heard about that one. It's good for beginners too, isn't it?
Absolutely. And then there's Deal Check, which is similar but offers some more advanced features. You can analyze properties on the go, which is pretty handy.
So it sounds like a mix of both simple and more advanced options is key here.
Exactly. And don't forget Rentometer. It's a great tool for checking rental rates in specific areas. Knowing what similar properties are renting for can really inform your offer.
Oh, that's super helpful. It's like getting a sneak peek into the potential income, right?
Yep. And speaking of potential income, having access to your local MLS can be a game changer. Some areas allow you to get off-market listings through agents.
That's interesting. So it's about building those relationships too.
Definitely. Networking with real estate agents can open doors to deals that aren't even on the market yet.
That makes sense. What about books or podcasts? Any recommendations?
Oh, absolutely. I'd say the book on rental property investing by Brandon Turner is a must-read. It's practical and full of actionable tips.
I love Brandon Turner. His style is so relatable.
Yeah, and for podcasts, BiggerPockets Podcast is a classic. They share real-life stories and strategies from investors at all levels.
Sounds like a great way to learn while on the go.
For sure. And another book I'd recommend is Real Estate Investing for Dummies. It covers a lot of ground and is very beginner-friendly.
I like the For Dummies series. They break it down really well.
Exactly. Now, when you're getting started, it can also be helpful to join a local real estate meetup.
Oh, that's a great idea. Networking in person can really build those connections, right?
Exactly. You can find like-minded individuals, potential mentors, and even partners for deals.
And it's a supportive environment to learn from each other.
Right. And here's a habit you can start today. Set a goal to reach out to one new person in the industry each week. It could be through social media, a local meetup, or even just a coffee chat.
That's a super actionable step.
It really is. And remember, you don't have to go full steam ahead. Just take baby steps. Start analyzing properties, reaching out, learning about your local market.
And then building from there.
Exactly. With all these tools and habits in your toolbox, you're setting a solid foundation for your investing journey.
So it's all about consistency and gradually building your knowledge and network.
Yes, and don't forget to celebrate the small wins along the way. They all add up.
That's such an important point. It can be easy to overlook those little victories when you're focused on the bigger picture.
Right, and being mindful of that can keep you motivated. So with these tools in your pocket, you're ready to move forward. Wow, Sarah, what a journey we've had today, right?
Absolutely, Mike. It's been really enlightening. So let's quickly recap some of the key points from our chat on finding off-market deals in 2026.
For sure. First off, we talked about the importance of building relationships, right? Networking with local agents, other investors, and even community members can really open up those hidden opportunities.
Yeah, and then there's the whole aspect of using technology like social media and property platforms to scout for potential deals. It's amazing how much you can find just by keeping your eyes peeled online.
Exactly. And don't forget about direct outreach, like sending letters or postcards to property owners. A personal touch can make a big difference in getting them to consider selling.
Right, and we also covered the value of understanding your local market trends. Knowing what's going on in your area helps you identify those properties that might be undervalued or overlooked.
And let's not overlook the importance of patience and persistence. Finding off-market deals isn't always easy, but it can truly pay off in the long run.
Definitely. It's all about building that wealth through real estate, one strategic step at a time.
Yeah, and remember, folks, real estate is a marathon, not a sprint. So keep at it, and don't get discouraged.
If you found today's episode helpful, please like, subscribe, and leave us a comment. We'd love to hear your biggest takeaway or any questions you might have.
And if you know someone over 40 who's looking to dive into property investing, share this with them. It could make a world of difference.
Absolutely. And next time, we'll be diving into some MLS hacks for investors.
That's going to be a good one.
For sure. We can't wait to share more insights with you all.
Until then, take care and happy investing.
Bye, everyone.